To investors, and we're going to be talking about loan options for first-time investors. So this is for the newbies. Number one would be hard money, and probably my favorite that we use the most commonly. Hard money is going to be from a big, more institutionalized investor. There's going to be points and obviously monthly interest-only payments. They're going to be looking at the property, evaluating it, coming up with kind of an ARV and an as-is value to give you the loan. Usually they will give you 90% of the purchase price, plus depending on the company, will give you up to 100% of the rehab costs as well. Those rehab costs are usually formed as a construction draw, which means they hold on to it until you complete a portion of the rehab, and they will fund the portion that's been completed. So it's based on work completed. So that's hard money. That's most commonly used by most investors. That's what we use the most of, and it's widely available. We don't have to search too hard to find hard money. Private money is going to be from a smaller investor, maybe someone with a large 401k or self-directed 401k, a private person with some money to invest. Terms are going to be a little bit more flexible depending on the person. They may fund 100% of the purchase price and 100% of the rehab. So it just really depends on the person and negotiating those terms with them. If they know and trust you, you can get very favorable terms using using private money. And usually they want to get that secured with the property. Same with hard money, they're going to form a deed of trust on the property, so that means they can foreclose on you if you don't pay. Probably the same with the private money person, depending on how sophisticated they are. But it's way more flexible. So number three would be JV or joint venture. So that's you finding a partner with some money. Say, you go to someone with some money, they're going to fund the rehab, fund the purchase price, and you're going to take care of all the work. At least there's got to be some sort of agreement there where they have the money, maybe they have a full-time job or something, it's a friend of yours, they want to get into real estate, but they don't have the time to do the rehab and handle all the ins and outs of the remodel and facilitating getting that property back on the market. So that would be a joint venture. You're going into business with someone else, they're investing in you and the property, you take care of the rehab and listing the property. You can get pretty favorable terms with that as well. Usually, you do a split of 50-50, 60-40, 70-30 split, whatever you can negotiate with that person. So all those are good options. JVing is another great option. Number four, and another one of my favorites, would be subject to or owner financing. This is when you're purchasing a property subject to an existing loan. That's where the subject to comes from, but another way to say it is just owner finance. So they have an existing mortgage on the property in most cases. That mortgage stays there in their name. You purchase the property and you just continue paying that payment. It's the seller's going to have to kind of understand and know what's going on for them to kind of go for that, or you have to be really good at explaining it, because it's kind of hard for them to understand. You're buying their property, but the loan's not going to get paid off, and you're going to be making those payments. They kind of have to trust you to make those payments because their credit is on the line. But there's clauses in any type of subject to agreement that if you don't make the payments, then they, get the property back. This is probably, this is my favorite. It's just less common to do an owner finance deal. Another way to do it would be to have a homeowner that owns the property, does not have a mortgage on it at all. They own it free and clear. And then you create a note or you create a deed of trust with that owner. So they basically step in and become the bank. Then you're paying that person directly, monthly interest payments. So they're basically stepping in as like the hard money lender, let's say, but it's their property and they are the lender. So those are a little bit more sophisticated, but very good options for first-time investors if you can find the seller that is open to it and understands what it is. Number five is getting popular, but we call this like the live-in flip, or you can use an FHA 203K loan for that. FHA 203K loan is a rehab loan basically, and FHA is only 3.5% down payment, so very little money needed to get that done. They also fund the construction costs, of course. So the only caveat is that you have to live in that property for a year. So that's what we call a live-in flip. You don't have to live in it while the work is being done, but you have to plan on living in it after for up to a year. After that year is done, you can sell the property, you can rent it out, you can do whatever you want. So that's the live-in flip or FHA 203K. You can also use a conventional loan doing this option, but with a conventional loan, they're going to have more restrictions on the condition of the property. If it's in extremely bad shape, the roof is leaking, stuff like that, it's not going to qualify. With an FHA 203K loan, they understand they're going to be rehabbing the property, so they're a little bit more flexible on the condition. So those are probably the 5 best ways. There may be a couple more, but those are the best ways to finance a flip for your first time with little to no money down, and get into the business and start flipping your first house. So let me know if you guys have any more questions. Again, this is Ryan with Trusted Investors. Follow us for more real estate info.